Coming up on Business Incorporated. Kenya is considering debt for nature or climate swaps to unlock funds for the construction of water dams. And Rwanda's central bank raises interest rates to the highest level since 2014. Plus, oil prices fall about 2%, heading for a weekly decline. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at what's happening with markets starting on the African continent. Let's see how it's playing out at intraday. We see it's mostly negative sentiment right here on the African continent, but we see the NGX there marginally up again, as we normally see at intraday. But it's up 0.05%. South Africa's GSE index, that's down a big 0.63%, while in Egypt, North Africa, there we see the EGX 30 down 0.19%, and we see Kenya, they're closing negative, down 0.15% yesterday. Let's look at what's happening in the Middle East now. It's squarely mixed sentiment in the UAE. Abu Dhabi index down 0.41%. Dubai index 9,978 points. That's up about 0.16%. Still within the region. Saudi Arabia index there, that's down about 0.23%. We see Qatari index down up almost 2% at intraday. That's what it closed at actually yesterday, talking about Saudi Arabia and Qatar. Let's move on now to Europe, where strikes have left Germany's most important airports empty today, with security and ground staff at 7 airports staging a one-day walkout across the country. Almost 300,000 passengers are affected at this time. Let's talk to Janelle Dumoulin right there now. Hi, Janelle. What's the update?
So what we know is that it's a bad day for travel in the cities of Frankfurt, Munich, Stuttgart, Hamburg, Dortmund, Hanover, and Bremen. The largest of those airports is, of course, Frankfurt. Now, Frankfurt Airport said ahead of the strikes that only emergency operations would be expected to proceed. So this is a very busy airport. Before the cancellations, more than 1,000 takeoffs and landings had been planned for this Friday alone, serving about between 120,000 and 130,000 passengers just in this airport. And it's important to note, this isn't just a headache for the airports, but the German flag carrier Lufthansa. It's already had to deal with issues earlier this week, where workers from the German telecommunications firm Deutsche Telekom accidentally drilled through 4 cables buried underground close to the Frankfurt airport. And that brought down Lufthansa's IT systems and grounded hundreds of flights. So after having gotten that situation under control, now they have the strikes to deal with.
What are the strikes meant to achieve?
Now, having checked in on the situation at various airports, it's all very quiet. The majority of would-be passengers were probably aware enough of the ongoing strike to hold off on going to the airport and to find alternative means to get to wherever they wanted to go. But it just happens to be especially bad timing, given that high-level delegates are in the country for the Munich Security Conference, the Conference on International Security Policy, running from today until Sunday. But at least those flights are exempted from the cancellations, as are relief deliveries for earthquake victims in Turkey and Syria. But here in Berlin, the Berlinale is also ongoing. That's Berlin's own international film festival. Stars like Anne Hathaway and Kristen Stewart are here. But obviously, a lot of people are also trying to get to the capital today at a time where especially domestic flights are basically impossible. But even if the strike action is only supposed to go on for 24 hours, it's already caused a lot of disruption. It's made a lot of passengers have to switch to train travel. So all the trains are very full across the country, and high demand has made tickets very expensive.
All right, Janelle, but how long can this last for, and what does this mean for travelers?
Well, according to Verdi, and that is one of the largest trade union groups here in Germany, and they're speaking for the striking staff in the airports, the workers are demanding 10.5% more income, but at least 500 euros more in order to offset inflation. That's 500 euros a month. But these demands have not been met. So the point is to put pressure on the employer. Union representatives have also pointed to what they call a catastrophic labor shortage among ground handling employees at the airport, and they want better working conditions in place before the travel-heavy tourist season in the summer. Otherwise, they say there will be chaos, and they're striking ahead of that in order to head off this potential chaos.
All right, thanks for the update, Janelle. I hope this is sorted as soon as possible so that passengers can be on their way. Let's move on now to Asia. We see Asia Pacific markets traded lower today as investors digested more economic data out of the U.S. and more hawkish commentary from the Federal Reserve there. If you look behind me, we see it's all red cross-board. Nikkei down 0.66%, with Kospi there down almost 1%, closing there. ASX 200 Australia there, that's also down 0.86%. So we're seeing quite bearish sentiment right there because of what we're hearing from the U.S. Fed at this point. It is begging for more rate hikes going forward, and investors are spooked at this hour now. Let's move on to the U.S., where it's kind of like a similar story right there. We see U.S. stock futures also down right now. Earlier there, 0.42%. That's the Dow Jones Industrial Average, and the tech-heavy Nasdaq there down almost 1% earlier today. Let's get a summary of yesterday's close from our correspondent, Maria Bird.
The U.S. stock market closed much lower on Thursday, the lowest it's been in almost a month. The Dow Jones closed at 1.3% down. The S&P 500 dropped by 1.4%, and the heavy tech Nasdaq was down by 1.8%. Many investors are also very concerned about the wholesale prices come out hotter than expected. This is also going to be a concern for the weeks and months ahead. The U.S. investors are also very concerned about whether or not the interest rates will have an increase more than expected, even though the Federal Reserve has promised that it will slowly increase interest rates and not have too much of a drastic increase. Many investors are looking at the U.S. economy and not sure if that will be the case. And they are looking at the U.S. economy potentially causing this U.S. stock market to have a troublesome weeks and months ahead.
All right, there we see oil prices there fell about 2% today. It's heading for a weekly decline. Brent crude futures is down about $1.92, about 2.2%, at $83.55 a barrel, while U.S. WTI crude futures, that's down $1.89 to $76.61 per barrel right there. Let's get a weekly review now and an outlook for next week. Join us now is Wachira Kariuki, Head Training and Research, Windsor Brokers. Join us via Zoom. Great to have you on the show.
Thank you, sir. Most appreciated. As Windsor Brokers, we're very happy to be here, sir.
Fantastic to have you. So it looks like oil prices are heading for a weekly decline. What drove sentiment this week?
Especially on the dollar, the Euro USD has been dropping, and it's almost heading to an all-time low of 1.0600. It's the lowest since in Europe, actually, this particular Friday. This entire week has seen new lows being broken. Of course, sentiment is driven significantly by the Fed Reserve statements that were released last week. There's a significant increase in the interest rates in the US. And the ECB also released a statement on the same, which has accelerated the decline. So we foresee the dollar gaining strength and the Euro USD hitting a new low. Actually, and also we've seen a significant increase in the US Treasury bonds. Their yields have increased. As I say, the interest rates have increased. So we expect a very consistent and persistent strengthening of the dollar against most currencies. The euro has been a significant decline. The GBP, the pound, has also lost significantly against the dollar. Of course, the USD has also hit a new high. As you know, there's a very strong correlation between euro dollar and USD. When one is a buy, another is a sell. So we are seeing significant hitting of new lows for the dollar as we continue forward.
Do you think the bears are in control of that oil market right now?
Completely. The oil market, as we speak right now, we've hit a new low of 76.11. dollars per barrel. The very last time this particular price was hit was on 7th of February. So we have seen a significant decline. We have hit a 2-week low for the first time. It's dropped quite significantly. And more importantly, we've had 2 days back to back where we are breaking new lows. And now we've hit a low of $76.1 per barrel. We expect it to continue going lower. And maybe any trader holding sell positions, I strongly suggest they should just hold their positions and see how next week plays out, because for sure you're in the direction of the trend. And our analysis show that generally it continues to be a strong decline going forward.
All right, let's look at the metals market now. You know, gold has been in the news most of last year. It did have that, incredible rally. But now it looks like $2,000 per ounce gold is looking really tough right now.
It is. It completely is. We have hit a very strong, we hit $1,825 per ounce. So as the market has declined, gold, which had a very strong bull run last year, seems to have taken a bit of a beating. There has been a significant decline, and week on week, for the last 3 weeks, we have always closed lower. And this particular week, we hit a new low of $1,827 per ounce. The last time this particular price was touched was on the 1st of January. So we've pretty much erased any gains that we have had for the past 1.5 months. And that shows you that the bear trend may have kicked in, and it's kicked in quite early in the year. And our analysis, our research shows that it might be a significantly strong bull trend, and it might continue way into end of November before maybe it stabilizes. And there's a very strong support level around $1,803 per ounce is possibly the next possible support. Otherwise, we don't see anything stopping it, and we expect a significant decline week on week, day on day going forward. All bear trends, all bear positions are pretty much making a significantly good return. So.
And obviously, all eyes on the Fed right now. We've been, getting some, Fed speaks quite hawkish, at this point. But what kind of news do you see as a strong catalyst to take gold above that $2,000 level?
It would have to be something extraordinary, like you say, the Fed Reserve speaking about the interest rates. They increased slightly by 25 basis points. However, the sentiment was very clear that they do plan to continue with that particular stance. They said around March, April, in the next quarter, there might be another quarterly information release, market release, for which we think might stabilize the market or shake the market quite a bit. Therefore, we are, as of now, we are holding a bear trend, but short of a very strong sentiment from the Fed and making the market turn around, we think that market is going to keep on dropping for a while. The only thing that can stop in its bear run right now has to be a very strong sentiment. Alternatively, China could also, or Japan could also release a statement to strengthen the yen, maybe that could come up about. Otherwise, fundamentally speaking, we think it's a significant bear. Technically speaking, it has broken all supports. It continues to break new supports and find new levels, and we think it's while we do not give any recommendations per se, as Windsor Brokers, research supports that maybe the bear trend is significantly strong, and it will take quite a while, at least a month or two, before it is able to start retracing again. That's our short-term sentiment, sir.
And obviously, most of the investors in these markets looking at the U.S. dollar. Let's look at the DXY. And now it looks like, is it starting some kind of uptrend again?
Yes, the dollar index has started some uptrend. As you very well know, the dollar index and the Euro USD have an inversely correlated. When one is strengthening, the other is declining. In fact, some people use the dollar index itself as a tool to be able to trade the euro dollar. So yes, the dollar index has turned around. It continues to find new highs. It's currently, let me literally just look for it in the market. It's finding new highs, and we're excited about what it might portend, because for as long as it's breaking into new levels, then that's a very good thing. So the dollar index week on week, right now it's trading at 104.49, which is a new high, because the last time it was at this price was on the 1st of January. On the very first day of the 2023 is when the dollar index traded at this particular price of 104.49. So therefore, it is breaking new highs. It has closed every week and in a new high. It has broken every high every week for the past 3 weeks. And therefore, we suspect it's a start of a very strong bull run for the index, which means a very strong bear run for the dollar. And we think it's going to, because the dollar is an average, the dollar index is an average of the strength of the dollar against all other currencies. We suspect it's going to be a strong bearish market for anything dollar correlated, and a very strong index continue to climb up from 104.49. I portend and I foresee this thing going all the way to 107 will be my next strong resistance on the weekly chart. That's my analysis, sir.
Yeah, I'm sure risk asset bulls wouldn't want to hear that right now, but what are you expecting next week for oil and gold prices?
I'll be, today's a Friday, so there's some major news coming out sometime next week, in the middle of the week, I think. And so we are expecting to see, I suspect after such a strong bull run after 2 weeks, I expect that to be stabilizing and maybe a consolidation of prices as the people who had and held those trades for the last 3 weeks exiting, and then after that particular exit, the bear trend will most certainly kick in unless there's something to stop it. So I expect next week to stabilize, but as we go into the last week of February, I expect the bear drop to continue. Rarely have we ever seen 4 weeks of bear trend for gold especially. So we normally expect it to drop after 3 weeks, stabilize, start trading horizontally, start consolidating as people who had held positions start to exit. Then the bear trend once again. It's called a breather on the technical chart. So we're able to see that people are exiting their positions. It does not necessarily change the trend, but it accelerates the bear trend after a while. Otherwise, nothing drops perpetually all the time. So a consolidation next week, then a drop in the following week, depending on the news that is coming out on Thursday and Friday next week, so which is some major economic news on the dollar. Yeah.
All right, thank you so much, Wachira Kariuki, Head Training and Research, Windsor Brokers. It was great having your perspective today. Thank you.
Pleasure's all mine, as always.
Welcome back to watching Business Incorporated live on Channels Television. To our next conversation now, the International Monetary Fund has revised upwards the 2023 growth projections for the DRC to 8%. For analysis now, we have Matt Kindiger, practice leader, Sub-Saharan Africa, front of you. Join us via Zoom. Great to have you on the show.
Hi, thanks for having me on the program today.
So do you expect DRC's upbeat growth to continue this year?
Well, certainly, yes. We have actually revised up our growth forecast for DRC, and we do expect it to be one of Sub-Saharan Africa's best performing growth markets. We're actually advising our clients to consider whether there are opportunities there because of the strong performance of the economy. Growth really is predominantly a story of upbeat mining activity, especially in the copper belt, from copper and cobalt. Not only are high prices supporting output, but we're also seeing new investments into the sector as well. We have quite an upbeat longer-term view for the market, especially because of very strong demand for electric vehicles and associated battery technology, for example. We are also seeing, in general, the IMF say that the exports and public finances are actually likely to improve over the next year or so. So certainly we are expecting the economy to perform quite well in 2023 and perhaps into the middle of this decade.
Are there any foreseeable risks to this forecast?
Yeah, so I mean, the biggest risk at the moment is the potential for conflict between DRC and Rwanda. Although it's not part of our base case, for the outlook for the market, we do believe there is a 35% risk of some sort of conflict or full-scale conflict emerging between the two countries. It is a downside scenario, but we have seen accusations escalate between Kigali and Kinshasa. Certainly this would affect investment into the country. It could also affect the operating environment for businesses. Although in our view, a conflict, if it were to happen, would likely be concentrated in the northeast of the country. It wouldn't directly affect the mining heartland of the south of the country or Kinshasa, the commercial capital, but certainly it is a significant risk for the outlook.
And definitely we can't talk about the country without talking about the currency. How do you see the franc performing, especially as the country is facing an election in December this year?
Yes, so the election in December this year certainly will contribute to volatility of the franc, and also we're likely to see considerable foreign currency shortages emerge. And this is because the central bank, the BCC, has been intervening quite heavily into the foreign currency market to ensure the franc stability. The franc really hasn't moved very much against the dollar since mid-2020, and so we do think some more volatility is inevitable over the next year or so. However, that said, the degree of depreciation that we're forecasting this year is likely to be limited, and this will be because high commodity prices will drive exports and forex revenues into the market. But as we get closer to the election, especially in Q3 and Q4 of this year, we are much more likely to see some more depreciation on the currency, and if not, some more severe foreign currency shortages to emerge. So the election does play a big role into the outlook for the currency.
Now, you did mention rising tension between the DRC and Rwanda. Any chance of de-escalation? And if there's no de-escalation, paint a picture of what exactly can happen to the economy?
Yeah, so our view is that the best route to de-escalation is likely to be East African community-led talks, although they haven't yet yielded any results. They're likely to be ongoing, and we do believe that there's going to be, both sides will pull back from the brink, and there will be some kind of peace settlement. Not necessarily a lasting long-term one, but it will avoid the worst outcome, which would be a direct conflict. In terms of the impact on the economy, so certainly there would be a negative effect on sentiment. We would see, as I mentioned, we are expecting more volatility of the franc, but there would be even more pressure on the currency in the weeks and months following the outbreak of conflict. And certainly the northeast of the country would be very severely affected. We are already seeing militia activity there. It's quite an insecure part of the country, so certainly there would be economic activity in that part of the country would be negatively affected. But our base case view is that Kinshasa would not be directly affected at all, actually. So commercial activity in Kinshasa would more or less continue as usual. And also the copper belt, the mining regions of the country in the southeast of the country, quite happily would be relatively insulated from a direct conflict, at least initially. So we would see that the direct economic damage of a conflict between Rwanda and DRC would be limited, at least in the short term.
All right, we'll keep tracking those economies. Thank you so much, Matt Kinniger, practice leader at Sub-Saharan Africa Frontier View. It's great having your perspective, and enjoy the weekend.
Thank you, you as well.
All right, now still in the northeast Africa now, we see Kenya is considering debt for nature or climate swaps to unlock funds for the construction of water dams amid a cash crunch. There's risk derailing spending on key development projects. The debt for climate swaps are aimed at further helping the government mop up cash for its water program. Debt for nature or climate swaps or financial deals that typically allow a country to restructure its debt at a lower interest rate or longer maturity, with the proceeds being allocated to conservation or green projects. That was in East Africa right there. And Rwanda's central bank has raised interest rates to the highest level since 2014 as it sees inflation remaining in double digits in the first half of the year. According to the central bank governor, the Monetary Policy Committee lifted the key rate to 7% from 6.5% due to prevailing economic conditions and to continue the fight against inflationary pressures that are affecting consumers' purchasing power. Annual urban inflation in Rwanda slowed for a second straight month to 20.7% in January and has been at more than double the 8% ceiling of the central bank's target rates in September. And global rating agency Moody's says Nigeria's central bank and some deposit money banks could delay the repayments on a cumulative $10.4 billion forex loan beyond their maturity date due to a shortage of foreign currency. In a report released yesterday, analysts at Moody's explained that the rated local lenders have placed the amount with the central bank in the form of derivative transactions, including swaps and forwards. The rating firms mentioned that a delay in repayment threatens the lenders' liquidity and could weaken their capital, as well as constrain their ability to repay their own foreign currency liabilities. However, Moody's clarified that the central bank has a strong record of repaying its obligations, while most Nigerian banks have a successful track record of recalling these foreign currency assets placed with the Central Bank of Nigeria. All right, that's how the markets perform, and those were the stories making the hour there in the business world. Thank you so much for watching. I'm Ladi Williams. Enjoy the weekend.